To keep your investment portfolio on target for financial goals, you want to balance risk and diversify your assets. That's the purpose of asset allocation, the process of dividing your portfolio among major categories like cash, stocks, and bonds. Historically, the returns on these three major asset categories have not moved up and down at the same time. So including a mix of these assets in your portfolio can protect against losses. There is no perfect formula for asset allocation. It differs with each individual, depending on their risk tolerance and time horizon. Risk tolerance is the amount of your investment you're willing or able to lose in exchange for greater possible returns. Risk tolerance is closely tied to time horizon, or the amount of time you have to invest. An investor saving to make a down payment on a home in 5 years might choose less risky investments than someone saving for retirement in 20 years. A longer time horizon allows more time to recover from loss. Asset allocation may be one of the most important investment decisions you make with your portfolio. Call us today to learn more.